you can see, here's an instance in Amazon's flat. Here's another instance. We're concentrating on this period right here. You can see, flat as a pancake. Well, then the question is, what do I do with it? I got a stock that's flat. Now what? Select the right strategy. The first thing you do is you choose your expiration series. Now that was February. It was February. I'm looking 3 to 5 months out. Because remember earlier I said that the moves take about 2 to 3 months in time for the move to fully develop. And you want to give it time to let those profits run. You also want to think about contingency planning. What happens if things go wrong? Well, for most of you, they have a very well-known curve on how time decays in options. And at the money options, they decay parabolically, which basically what that means is that the rate of time decay speeds up as you get closer to expiration. Well, this gives us an opportunity to avoid a catastrophic loss. If the move takes 3 months, I want to buy a 4-month option. If the move takes 2 months, I want to buy a 3-month option so that I can avoid that catastrophic time decay as the option gets closer and closer to expiration. In the case of Amazon, it was February, so I just simply count out March, April, May, 3 months. I look for May. There were no May options listed. I then look for June. There were no June options listed. So I got to go to July. 5 months. Makes it simple. So that's basically, sometimes I'll be down in my basement. Well, I don't do that anymore because I have software to do it for me. But it used to be when I was doing this by hand, it's February. Okay, what is it? March, April, May. May, June, July. Okay, July it is. I had to do that, but now I don't have to do that anymore. Okay, again, we want to keep it very simple. We want to use straddles and strangles if the asset, and we want to use straddles or strangles. If the asset price is in the middle of 2 strike prices, choose the strangle. Otherwise, choose the straddle. What that means is, if you have a stock that's at 57.5, you have the 55 strike and you have the 60 strike. Well, 57.50 is right smack in the middle of it. So I need to choose the strangle. And the strangle would be the 55 put and the 60 call. If the stock is right around 54 to 56 in that range, then I'm going to choose the straddle. I'm going to buy the 55 call and the 55 put. The next thing you do is you can use a calculator, either the Chicago Board Options Exchange or any options calculator out there, and you can put the data into the calculator to come up with the fair value of the options. This happens to be the CBOE option calculator. It's a great resource for options information. I mean, a fabulous resource. And then the next thing you want to do is you want to choose your exit strategy. And here's where it gets down to just being prudent in your planning and choosing strategies that are appropriate for individuals. In this particular instance, when you buy a straddle or you buy a strangle, it's impossible to have a catastrophic problem prior to expiration. Now, some of you might be aware of, at expiration, you need to get out of your positions because there's an automatic assignment provision in stock options. So you need to, if your options are in the money, you got to sell them before they expire. Otherwise, there are potential problems. But generally speaking, if you buy a straddle or you buy a strangle, it's really hard to have a serious problem. So the next thing you need to do, that tells you about your contingency planning. The next thing you have to do is, how do I take my profits? And you want to use volatility and probability to determine your stock price targets and act accordingly. I think, this is another graph of Amazon. In this particular instance, we put the position on. Amazon made a pretty good move for us. We put the position on over here. We put the position on in early February, right when it went flat right there. And the stock started to move down. And I thought, okay, well, I'm going to make money on my puts. But instead it turned around and it started moving higher and then gapped up. And it's right in here that we're starting to take some profits and just rode it all the way up until we get up here sometime right in this period right there in July. At that point, the options, they just ran out. So then you have a choice. You can either just let the options expire and take your profits. You can sell your options at that point. Or there is another strategy that in this particular instance I used. It's called rolling up and out. And what that means is we bought the July 2250 calls and the July 2250 puts. The stock got up to about, about $45. Well, I went from the July 22 and a half out to the November 50s, I think it was. I don't remember the exact one right now. But that's rolling up from a lower strike to a higher strike, rolling up, and then out to a further expiration month. The next thing we can do is we can do them all with odds online. Just 1, 2, 3. And I'll show you how to do that. But what I'd like to do now, I'd like to take a step back and go back to these earlier screens, spotting low volatility. And what I'd like to do is show you step by step how we would do that live. Okay? So you all up for it? All right, here we go. This is the way, this Excel method is the way that I used to do it all previously. And fortunately, software has made it substantially easier. But I want you to just see, you don't have to go out and buy any fancy software if you don't want to. The software is just going to help you speed things up. Now, y'all may want to write this down. What we're looking for is a situation where a stock is extremely compressed. Everybody follow that? We're looking for a stock that's extremely compressed. This happens to be the OEX index. It's one of the first stock index options to trade. What we're looking for, and these are the exact parameters. Remember I told you I use exact numbers. I'm looking for a relationship between 3 historical volatility numbers. I'm looking for a long-term, shouldn't say long-term. Long-term in options is 100 days. So I'm looking for a long-term volatility compared to 2 short-term volatilities. And here they are at the top of this screen. I'm looking for a comparison between the 10-day historical volatility, the 6-day, and the 100-day. And what I'm looking for is when the 6-day is less than half the 100, and when the 10-day is less than half the 100-day. So we're looking at statistical volatility. Yeah, this looks about right. This is October 2003. I'm looking for an instance where both the 10-day and the 6-day historical volatilities are both less than half the 100. And here's a clear instance in October 16, 2003. The 100-day statistical volatility, 1748. Does everybody see that? I'm looking for this number to be half the value of that one, and for this number to be half the value of that one. Basically what it's saying is that over the past 2 weeks, the stock market had been flat as a pancake. It had barely moved. And so we're looking for this number less than half, 6-day historical volatility, less than half the 100-day historical volatility, and I'm looking for the 10-day historical volatility to be less than half the 100. So that's what we're looking for. When that happens, we say the stock is unusually compressed, and we expect it to break out up or down as long as it's not compressed for a fundamental reason. That's it.